One step forward and one step back. Final approval for Pfizer's vaccine. Congress moves forward on spending, but tragedy mars the already difficult pullout from Afghanistan. This is Bloomberg Wall Street Week. I'm David Westin. This week, an extended talk with GM Chair and CEO Mary Barra about her quest to turn an iconic American car company into a tech giant and turn our cars into an app platform, just like our phones.
The fact that we have the hardware and the software and really the relationship with the customer, I think is why we have a really bright future.
And special contributor Larry Summers tells us what Fed Chair Jay Powell should have said at the Jackson Hole Symposium.
I think the inflation risks are graver than those that the chairman recognized.
It was a week full of anxiety and even tragedy, but one tempered with hope on some fronts. Hope that things may get better soon as the FDA gives final approval to the Pfizer-BioNTech vaccine, even as the COVID numbers show signs of cresting.
Delta is stronger. It's making inroads into the vaccinated population, but the vaccines are still holding up.
The House returned to Washington in a rare August session and moved forward on infrastructure and on a massive budget package.
The yeas are 220, the nays are 212. The resolution is adopted.
But all of it was put in grim perspective on Thursday when explosions killed U.S. servicemen and civilians alike outside of Kabul airport, where thousands were massing in an effort to get out of the country ahead of an August 31 deadline.
Those who carried out this attack, as well as anyone who wishes America harm, know this: we will not forgive. We will not forget. We will hunt you down and make you pay.
And the markets this week followed the news, more or less, with advances early in the week giving up gains on Thursday after that attack in Kabul. But then Friday, it was all about the step forward, with Fed Chair Powell's dovish taper remarks spurring the S&P 500 to its 52nd record close for the year. It was the best week for small caps since March, and financials were the second best sector of the week. The 10-year yield was up a bit for the week, but still ended up just a hair above 1.3. So if the markets were really all about Chair Powell this week, what was it that he had to say? Well, he pretty much threaded the needle on tapering and raising rates.
At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test.
And now we want to get a reaction to what Fed Chair Jay Powell had to say at the end of the week from our special contributor at Wall Street Week, Larry Summers of Harvard. So, Larry, you read what Jay Powell said. What was your reaction?
I was glad to see him moving towards beginning tapering this fall. I still think he's operating within the same paradigm that he's been operating in, which, as you know, and those who've been listening to the show know, I don't think is quite right. He made a whole set of arguments on the serene side with respect to inflation. And obviously, he may turn out to be correct in those arguments, and there are a lot of people who agree with him. But I was struck, for example, that he didn't say anything about the housing sector. That's the largest part of the consumer price indices. I saw a statistic, Bloomberg actually had it the other day, that said on average when a new tenant moves into a rented residence, they're paying 17% more than the old tenant. That suggests a lot of rental price inflation. If you look at owner-occupied houses, the prices are taking off. None of that has been reflected yet in our price indices. And yet, on any common sense definition, that's surely inflation. And so my guess is you'll start to see the housing component of inflation show up as rising pretty rapidly, or if you don't, it'll reflect defects in the way we create the price indices. The chairman mentioned rightly that we've got record levels of job openings and workers are turning over very fast. Workers are quitting their jobs. I'd have thought that all of that would be a signal that in a labor shortage economy, you'd be starting to see much more rapid wage increases than you'd seen historically, but that was a process that would take a certain amount of time. He was more serene about all of that. He was referencing that we had 4% unemployment before COVID without rapidly accelerating inflation, and he was right about that, of course, but I see that we're having far more structural change in the economy as businesses rethink their business models, when people aren't going to be coming to the office, as people rethink their lives after a year without commuting, as the whole structure of the economy changes. And I think with all that structural change, you're likely to see some substantial increase in the level of unemployment that the economy can sustain without excessive inflation. So there's no certainties, but I think the inflation risks are graver than those that the chairman recognized. I think that the toxic side effects of QE are rather greater than the chairman recognized. So in the range of places where this speech seemed likely to come down, I think this came down in a relatively good place from my point of view, pointing towards a taper this year. But in terms of the issues I've been concerned about for quite some time, that we're kind of making a bit of a paradigm error. I didn't expect that the speech was going to represent a deviation from the paradigm, and I don't think it did.
So, Larry, the day before Jay Powell gave his speech, you wrote an essay in the Washington Post, in which you really took on the question of quantitative easing. You mentioned inflation, which you just talked about, but also some of those toxic effects, which included things like the tenor of the debt, something you've talked on this program before, that overall with the federal debt, we're actually going into the short side when we should be going to the long end, and also asset bubbles and pumping money in the economy by giving it into financial assets. Tell us about why you think that would be wrong, and maybe as important, do you think QE should go to zero?
Yeah, I think QE, I think the question is like, as I use the analogy in the column, it's like withdrawing from Afghanistan. It's pretty clear that after 20 years, the right thing was for the United States not to be continuing in a war-fighting mode in Afghanistan, but you can't get there necessarily overnight, as we're learning painfully. And in the same way, I think we clearly should have zero QE, which doesn't mean we can get there overnight, or we can get there with a drastic lurch. Why? Every homeowner in America is trying to lock in a long-term mortgage rather than moving towards a floating rate mortgage. The government should think the same way and be terming out the debt. What QE does by having the Fed issue interest-bearing bank reserves to buy up longer-term debt, when those interest reserves can float upwards, it's shortening the maturity of the debt. Given the epic levels of debt we have, and given the very high levels of fiscal uncertainty we have, why would we want to be terming in the debt right now? If you think it's a good idea in order to stimulate the economy, I think the risks are more on the overheating side. But if one thought that it was a good idea to stimulate the economy by printing interest-bearing money, the question would be, what should you spend the money on? And of all the things you could spend the money on, the thing that it seems to me would help the wealthy most and do the least to promote demand is buying up financial assets. And that's what QE is. I'd rather see us, to the extent we want to do this, use fiscal policy. Again, I don't see the problem now as stimulating the economy. I see the risk as overheating the economy. But if we want to provide stimulus, I don't think QE is the right way to do it.
Larry, finally here at the end, briefly, let me turn to a different subject. We've seen the crisis in Afghanistan evolve into a tragedy during the course of the week. If you were sitting in the Treasury right now, what actions would you be considering taking in response to what's happening in Afghanistan?
I would feel the sadness and concern that every American feels. I would feel a special need to be in close consultation with allies on all matters, given that there had been some sense of breakdown in communication between allies. I would be thinking ahead to what could be done consistent with our principles about not using finance to support terror, and at the same time responding to the humanitarian needs of the Afghan people, and what kind of guidance the United States should seek to give to the international financial institutions. And I'd sure be paying attention to my various programs that were directed at containing and sanctioning corporate finance.
Okay, Larry, thank you so very much.
Terrorist finance.
Thank you so much. That's our special contributor at Wall Street Week. He's Larry Summers of Harvard. And now let's listen to some of what we've heard from various Federal Reserve presidents over the course of the week talking to Bloomberg.
Look at the progress that the economy has made so far. It really does suggest that we've come to a point where we can begin to ease up on the amount of accommodation provided to the economy.
We've been at a very extreme level of accommodation, and I think that the strength of the economy calls for us to pull off of that a little bit and let the economy stand on its own.
We put this accommodation in place because of the health crisis, and we will be able to remove it now because we are slowly, carefully chipping away at the health crisis, but we're not there yet.
I do believe we should start the asset purchases adjustment process soon. I mean, literally as soon as possible. And I would like to see us do that process gradually over, say, 8 months.
Coming up, we talk with former Fed Governor Dan Tarullo of Harvard about the politics of reappointing Jay Powell and whether there should be more coordination between the Fed and the Treasury. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It was a big week for banks, central and otherwise, as Bank of America's longtime head of investment banking and COO, Tom Montag, announced his retirement, leaving a big hole and raising questions about succession at the bank. And Fed Chair Jay Powell appeared at the Jackson Hole Symposium amid speculation about his future as well. We spend most of our time worrying about the independence of the Fed from all political influence, but is that realistic? And if it were possible, would it be the right thing given the enormous influence the Fed can have over the economy and our lives? Dan Tarullo served on the Federal Reserve Board with Jay Powell. He is now a professor at the Harvard Law School. So Dan, thank you so much for being with us. So address that question. I mean, we have a lot of influence of the Fed right now on our day-to-day lives as well as the economy. Is there a role for some sort of a political factor here? And is it possibly healthy for Jay Powell to be thinking today, as he was talking, you know, I do need to think about reappointment?
Well, David, you know, Bill Martin, one of the famous past chairs of the Fed, for whom one of the Fed board buildings is named, characterized the position of the Fed as the Federal Reserve was in the government. It was independent in the government. It was not independent of the government. And what that means is that the relationship between the Fed and democratically accountable branches of government, the president and the Congress, is an issue of ongoing importance. So if you had a system whereby the Fed were self-perpetuating and each chair chose his or her successor, that might make some monetary policy people happy, but it would really strain any notion of the Fed being accountable ultimately to the Congress. And as you know, Congress has the powers in Article 1 of the Constitution that allow the creation of the Fed. So I think what we see with the 4-year appointment term, what we see with the requirements for testimony, are ways in which Congress has tried to provide some political responsiveness, some political accountability without making the Fed adhere to the day-by-day wishes of the administration.
Yeah, and stopping short of a day-to-day coordination of the administration, apart from Congress and the Fed, what about the Treasury and the Fed? We had Larry Summers on earlier in this program saying there's an issue of the tenor of the debt right now, given what they're doing with bond buying. In fact, we're sort of going more short-term and the debt doesn't make sense. Should there be some mechanism for more coordination? Not control, but coordination.
Well, I mean, in fact, and I assume that this is going on between Janet Yellen and Jay Powell, there's always been a weekly lunch, usually, sometimes breakfast, between the Fed chair and the Treasury secretary, where they go over a range of issues. Those meetings can be more frequent in periods of stress, obviously. But even in normal times, fiscal policy and monetary policy are dependent on one another. And in less normal times or new kinds of times, the relationships between the two are probably sometimes harder to parse. And so it does call for at least more communication between Treasury and the Fed. I mean, something that people may have forgotten is that for most of the good part of the history of the Fed, there was a kind of subordination to the Treasury Department that formally ended in 1951. But the interest of the administration and often of Congress in keeping interest rates low is an ongoing interest. And the Fed always needs to be in a position of deciding what its posture is vis-a-vis current fiscal policy.
Dan, we all heard from the current chair, Jay Powell, today as part of this Jackson Hole Symposium. A year ago at this same symposium, as I recall, the chair announced a new framework for determining monetary policy based on really being willing to go above the 2% number on inflation. Some people now, including Larry Summers, are saying, you know, that framework maybe was never a good idea, but it sure isn't now because it was dealing with the demand side issue and now we have a supply side. Is it possible the Fed has sort of painted itself in a bit of a corner and gotten too stubborn on its monetary policy by having that framework?
I don't think so. I mean, look, there are issues in the execution of the framework, which I'll get to in a moment, but it seemed pretty clear to a lot of people, including people who were worried about secular stagnation, that the Fed framework, which had prevailed in the pre-global financial crisis period, needed to be changed. And what I think you saw last year was not really a radical break, but instead the culmination of an evolution of the Fed's thinking about the relationship between employment and inflation. I think that difficulty has been that the Fed at that time expected that it was going to have a period of somewhat sluggish growth in which it could fill out its meaning to maximum employment and how long inflation had to be above 2%. And with the amount of fiscal stimulus we've had, the quick recovery in the economy, I think the Fed was back-footed a bit, and it's perhaps been a little less nimble in adapting to the new circumstances and describing what those metrics mean under these circumstances. But I actually don't think it's the framework itself that's the problem. And indeed, I tend to agree with those who think that periodically the Fed should revisit its framework, not because the framework sets monetary policy, but because it sets the framework for discussing monetary policy.
So Dan, just briefly here at the end, I wonder whether Jay Powell would have picked this time to give a major address that all the markets and all the pundits would be paying attention for monetary policy if there weren't Jackson Hole. And that leads to the question, why does Jackson Hole exist?
Well, I mean, the historical answer is the former Federal Reserve Bank of Kansas City president started it in 1981, invited Paul Volcker, and Paul Volcker came. And since then, it's been kind of the centerpiece of the summer for monetary policy. I think the traditional issues people have raised around it, David. One, should you have it at a vacation spot? I mean, it's a national park; it's still a vacation spot. Two, the preferential access that some reporters and some academics and some even market actors get. I don't think people would be at all worried about that if the chair were not there for wasn't this year, of course, because it was virtual, but normally the chair is there for 2.5 days. And that's the big light in the backyard that attracts the moths. And so the question really does become, should there be something like that does give the preferential access? Let me just add one thing. From the board, the Federal Reserve Board's own position, it's a mixed blessing. It's a nice vehicle for getting across a big message when you want to. But oftentimes, the Fed chair doesn't particularly want to get a big message and doesn't want a lot of anticipation. And to the degree that they feel they have to go, it kind of puts them on the spot.
And Dan could have another vacation. Thank you so much to Dan Tarullo of Harvard, the former Fed governor. Coming up, we take a look at the week ahead on global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Let's take a peek at what's ahead next week on Global Wall Street.
David, we've been closely tracking the Evergrande saga as we wait to learn if the troubled Chinese property developer will get financial support from the government. It reports earnings next week, along with Meituan, which has also been in regulators' crosshairs. Plus, earnings from Chinese banks will offer clues how systemic risks and regulatory curbs could weigh on profit growth for lenders. And amid the debate over if emerging economies can withstand Fed tapering, we get a GDP report card from India and PMIs from across Asia.
Thanks, Sophie. Investors will be watching the OPEC meeting on Wednesday as it continues to bring oil supplies back onto the market. That's in response to the rising demand, though the spread of the Delta variant could jeopardize prospects for the second half. And we also have that CPI data out for Germany, France, and Italy next week, so investors will pass through that for the latest read on inflation. Romain?
Thanks, Ritika. On the heels of the Fed's Jackson Hole Symposium, investors now face a wide swath of economic data in the week ahead to determine if that substantial further economic progress Jerome Powell said he's looking for, it's really there. We're going to get a read on the housing market with reports on pending home sales, mortgage applications, and the S&P Core Logic Price Index. ISM and market manufacturing PMI data also on tap, as are the latest government numbers on factory orders in July. And the week will round out with the August U.S. jobs report. And keep an eye on the CDC. An advisory panel is meeting to review the need for COVID booster shots. The Biden administration wants Americans to begin getting those boosters as soon as next month, but it needs an official recommendation from the CDC and sign-off from the FDA. David?
Thanks to Sophie, Ritika, and Romain. Coming up, the revolution that's coming to the auto industry, with all the challenges and all the opportunities, with Mary Barra, Chair and CEO of General Motors.
We've redesigned many parts of the company. The way we fundamentally design vehicles has changed.
That's next on Wall Street Week on Bloomberg.
It was only a dozen years ago that the American auto industry stood on the brink of collapse during the great financial crisis, something President Obama said he could not let happen.
We cannot and must not, and we will not, let our auto industry simply vanish.
And so the industry went through a painful restructuring to emerge smaller, more efficient, and more profitable. And no sooner did it get through all that than it has to reinvent itself all over again as the nation and the world move to electric vehicles.
A future of the automobile industry that is electric battery electric, plug-in hybrid electric, fuel cell electric. It's electric, and there's no turning back.
Is the industry up to this new challenge? And if it is, will it be the traditional car companies who lead the way? Or will they have to make room for the pure play electric vehicle makers like Tesla and Rivian? Dan Ives of Wedbush says President Biden is creating a huge new market.
This is the start of what I believe is a $5 trillion market, with definitely Biden kicking off the green tidal wave in the U.S., which is underperformed when we look compared to China and Europe.
And Ives says GM is well positioned, that as GM proves out its EV vision over the coming years, the stock will be re-rated more as a disruptive technology and EV play rather than its traditional auto valuation. Kathy Wood of ARK Investments, on the other hand, says the traditional automakers are just too far behind to catch up.
The traditional auto manufacturers, if you look at their R&D budgets, or you look at GM's, 10% of its R&D, $25 billion in capital spending, is allocated to electric. They should be at almost 100 now, given what's about to happen. They have just gotten started, and what they have delivered are cars that don't even meet, whether it's range or other metrics, the Model S circa 2012.
But in the end, it may not be just electric cars that decide who wins and loses. It may be a cluster of different tech innovations that come with those EVs. Or so says Adam Jonas of Morgan Stanley.
Ford is showing a bit of urgency too. It's better late than never. Yeah. But General Motors is our pick under the leadership of Mary Barra, who's executing a phenomenal turnaround here with real action. This company is starting to present itself as a viable, let's say, pre-SPAC ETF of 2.0 unicorns.
We went to Mary Barra herself, chair and CEO of General Motors.
GM has been a manufacturing company, as far as I can tell, for over 100 years, since I think 1908, thereabouts, you were founded.
Right.
Are you trying to turn it into a tech company?
Well, I really think the automobile is becoming a software platform. So by definition, with all the software services, subscriptions that we can do, we really are becoming a software company. And I guess if you want to describe that as tech, but the thing that I think is important for General Motors is we only open up that opportunity when we sell the hardware, which is a vehicle. But that's why we're so excited, because we think we have tremendous growth in front of us.
So what does it take to take this time-honored company as a manufacturing company and really make it a software company? Use your word, software rather than tech.
Yeah, well, I think first of all, we've redesigned many parts of the company. The way we fundamentally design vehicles has changed. We have all of the software engineers and that technology all in one group, because on a vehicle there's hundreds of millions of lines of code. And with the vehicle intelligent platform, which is the electrical infrastructure in the vehicle, we are now able to do over-the-air updates, and that is giving us this platform to just do all new types of services for customers. And it's really an exciting time in the industry.
So you have this vision for your company as a software company. Do the young software engineers coming up agree with that vision? There are a lot of other big tech companies out there, and it can be Amazon, it can be Netflix, it can even be a car company that starts with a T that started as a tech company. Can you compete for the best and the brightest among the software engineers?
Well, we can and we are. I mean, we have hired over 8,000 employees to General Motors just this year, and most of them are software talent. And they're coming to GM, I think, for a couple reasons, but one, because they want to be part of creating a world with zero crashes, zero emissions, and zero congestion. And so the transformation that's happening at General Motors, they want to be a part of. And then once they come to General Motors, we're working really hard to make sure they see the opportunity, that it truly is an environment where they feel engaged and there's inclusion. So we're seeing fairly low attrition, and again, we're bringing in thousands of engineers.
If I'm an investor, how do I think about General Motors today? I mean, there's sort of time-honored traditions like price-earnings ratios, for example, that apply to tech. And for example, General Motors, last time I checked, was in the 6 to 7 times earnings, right? Tech is trading up in the 27, something like that. Are you going to move toward that 27 as a multiple?
Well, we definitely think there's a huge opportunity from a multiple perspective, because a lot of times people in the past have thought about the auto industry as a very cyclical business. But when you think about the fact that General Motors, we have the opportunity to grow with our franchises from an ICE perspective, but then the EV part is complete growth, and the software and services on top of that are growth as well. And then when you look at expanding into new businesses, whether it's OnStar Insurance or what we're doing with BrightDrop, that is more than just an electric light commercial vehicle, but it's a whole ecosystem of how we can move goods better and make those deliveries. And with partners like FedEx Express, they're seeing the efficiency of the systems that we're putting in play.
So Mary, take us forward 10 or even 15 years, and let's assume everything you want comes to pass. What does GM look like? I mean, for example, you've mentioned it as a software platform with other services that are attached to it. What percentage of the revenue will come from actually selling the vehicles as opposed to the services?
I actually think that if we fast forward 10 years, I think the software services, subscriptions, and the other adjacent businesses that we can grow into because of the technology that we have will be equal or greater than what we'll have from from selling the vehicle. That's my vision, and I think that's well within reach when we look at the different total addressable markets and the businesses that we're entering.
What does that do to margins? Do you expect higher margins on the services than you would normally get on a manufactured product?
Well, we see it today on our businesses like OnStar. We see a higher margin profile than we do on the actual vehicle. But let's not forget, you've got to sell that vehicle to have access to that. And that's where General Motors also, we have a reason that people should believe that we're going to lead, because we already sell more vehicles in this country than anyone else, setting aside some of the limitations with semiconductors right now. And we have the highest loyalty. So when you look at the scale that we have, and then the software platform that we can access because of that scale, that's where the growth, I really think, is a huge opportunity for us.
You are a traditional car company moving into this software business, as opposed to what some people call a pure play that started out as software. What advantages and disadvantages do you have over against the people who are pure play, who started out there?
Well, I think the transformation that we've made over the last 5 years, it wasn't like we just woke up today and said, oh, we're going to be a software company. We have been on this journey we've reorganized the way software is developed in the company. We've brought in tremendous numbers of software engineers, and we already have proof points out there. We launched the Vehicle Intelligent Platform starting in 2019 with no issues, and that was all software done internally. So I think we already have many proof points that people will start to realize that we already are a software company, and the fact that we have that capability, and the fact that we have the hardware and the software, and really the relationship with the customer, I think is why we have a really bright future, and I think people hopefully will start to see why we're in, really in a position to capture that more quickly than others, and especially pure play software companies.
As you say, you have some experience in the marketplace with this already, with OnStar, for example, you mentioned. What does that experience tell you about that consumer demand? I mean, it's one thing to be able to provide something that's a good idea, it's another thing for consumers really to want it.
Well, we're seeing growth with OnStar, and OnStar, we have over 12 million active connected vehicles. We've been in the business for 25 years, so we have a lot of learnings. We actually have over a trillion connected miles on the road. And today people can buy a safety and security package, they can buy the connectivity package, they can buy both, and we're seeing growth in both types of subscriptions. And really the vehicle, there's many people's stories throughout the pandemic where their vehicle became their office because of the connectivity we provide.
So these are potentially exciting opportunities. Do they also bring some challenges? And let me name one specifically, cybersecurity. When you talk about my vehicle being connected to everybody knows what's going on with me, what I'm doing, I'm using it very precisely. That could be hacked. And right now we're seeing that problem in a lot of critical services around the country. What are you doing as GM to protect this from cybersecurity?
Well, with the Vehicle Intelligent Platform that we rolled out starting in 2019, a big part of the way we redesigned that was with a focus on cybersecurity. We have some of the leading cybersecurity experts in the company from an auto perspective, because we recognize how important it is. So it's built on layers of defense, and we've had learnings from other industries, but that's now core to our vehicle with the Vehicle Intelligent Platform.
So in this world, again, go forward 10 years, I understand you're going to have a lot more services, maybe even more service revenue than vehicle revenue. What does that do in terms of the overall number of vehicles sold? Are you envisioning a world in which GM sells fewer vehicles, but perhaps returns higher profits?
No, I'm looking for a world where we continue to grow share, and that just continues to expand the growth opportunities with the software. And I think when I look at the ULTIUM platform that we're putting into market this fall, you know, many other traditional OEMs are just thinking about or starting to work on dedicated electric vehicle platforms. We have one, and it's a building block structure, so we can go all the way from a small crossover all the way to a super truck like the Hummer EV.
One of the other goals you set for the company is to be the most inclusive company in the world, as I understand it. Why is that important as a business?
Well, first, when I talk about wanting to be the most inclusive company in the world, it's not a title we want to hold on our own. We want everyone, because we think that's the world that people want to live in. But for General Motors specifically, that is a way for us to get the very best talent, because when they come to work, they feel that they can bring their true self to work. I mean, I just talked about this on an employee town hall over the last couple days and said it's about feeling valued, feeling that the work you're doing is important and that you can be yourself. And that's when you can do your best work. So I think it's vitally important that we continue on that journey.
You've also made a commitment, which I think maybe includes both the inclusion point, but also the electric vehicle point, of climate equity as a priority. Explain what you mean by climate equity. Why is that an issue today?
Well, I think it's, as we make this transformation to electric vehicles, we need to make sure we don't leave anyone behind. So it's from a work perspective, making sure that people are retrained to be a part of creating the vehicles and the software for this future. The second is making sure there's access, whether it's buying new vehicles, used vehicles. Then it's about infrastructure. We need to work with communities and with the government to make sure that every community has the right charging to enable electric vehicle ownership. And then finally, it's working with communities to make sure as we make this transformation, you know, we fund areas and help communities close the gaps. So I'm very excited about that, and that's where we've dedicated $25 million to work with communities to achieve these goals.
It strikes me that when we look at the first Ultium-based vehicles you're bringing out, they are the Hummer, and they are going to be the Lyric, being part of next year, as I understand it. Relatively high-end vehicles. What is the opportunity to provide electric vehicles to more the middle class and even, yes, the lower middle class, things that are more economic?
I think that's another strength that General Motors has, because we already have a full portfolio of vehicles. And when you look at the number of vehicles that we'll have by 2025, I can assure you there is going to be affordable vehicles that customers are going to want to own across many price points and segments.
Is the government going to need to subsidize the purchase of electric vehicles, at least for the foreseeable future, particularly for some of the groups that we're talking about?
Well, when we talk about what we think the government can do to support the adoption of electric vehicles, it's, you know, one, making sure there's a robust charging infrastructure. It is changing the EV tax credit to make sure it doesn't penalize first movers that, you know, already have many electric vehicles on the road today. And then finally, we think they can incent with R&D credits to both engineering and investment in the country. So that's the role we think that they can play to speed EV adoption. And we'll be working closely with the administration and local and state governments as well.
Finally, Mary, give us a sense of where these vehicles are going to be made. And it takes me back to some of the things we've talked about before, which is Canada and Mexico particularly. There's some disputes right now coming out of the USMCA about what's going on in Mexico. How critical is it for GM to be able to continue to manufacture in Mexico?
Well, I think when we look at the footprint we have, we want to leverage it because that's an advantage, because that's investments that have already been made. But the bulk of our footprint in North America is in the United States. And so I think we can do a very appropriate job of creating jobs in the U.S. as well as leveraging our footprints in broadly in North America.
Coming up, more with GM's Mary Barra on the electric future of her company.
We need to earn that customer who only has one vehicle and needs it every day to get back and forth to work. And also it has to be affordable.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We return now to our in-depth conversation with Mary Barra, Chair and CEO of GM. When we make this conversion from internal combustion engine vehicles into electric vehicles, it's a lot of cars to replace. And if you're going to get to the goals the president set, and you have set, by the way, for General Motors,
yes,
it's going to be a lot of conversion. What is the pace of that? I mean, is it basically back-end loaded? Take the 2035 date that you've put out there. How much of it's going to be seen by 2025? How much are we going to see by 2030?
Well, I think we are going to have the portfolio, and we have the manufacturing capability that we're going to be able to build, and we're planning for having contingencies if the adoption happens more quickly. I think getting the infrastructure right is going to be key, because we need to earn that customer who only has one vehicle and needs it every day to get back and forth to work. And also it has to be affordable. But customers have told us if it's a beautifully designed vehicle in the segment they want with about 300 miles of range, and then it's priced appropriately, they're all in.
We tend to think about the United States when it comes to General Motors, but you have a very substantial operation in China, have been there for a very long time. How important is China to your EV plans?
Well, I think China is a very important market to us. We're number 2 in China with our Cadillac, Buick, Chevy, and then also our Wuling and Baojun brands with our SGMW joint venture. And so we have a very strong position in the country already. We're aggressively moving to introduce more electric vehicles. Right now, the Hongguang EV is the fastest selling or the highest selling EV in China. And so we think that's just continues to be a very important market for us to continue to grow and be in a leading position.
As you look at profit margins, because you've always had goals for profit margins at GM, last time I checked, there's about 8%. Now you're shooting for 10, something like that. What does a GM look like in terms of profit margins when you're totally EV?
Well, I think the opportunity that we have is we continue to invest in developing battery technology. We see the costs coming down. And so we'll get to a point, because also ICE vehicles, because of the requirements from a regulatory perspective, they're going up. So over a longer period of time, we think we're going to not only have affordable electric vehicles with, very well-priced battery capability, power density, but then also the software business that we're going to unlock on top of it, because the vehicle, whether it's ICE or EV, is really a software platform.
You mentioned the battery technology, which is key to this. You have made a decision to pair with LG Chem and to really have your ULTIUM platform, which this Hummer will be made on, as well as the Lyric. At the same time, you've had some difficulties recently with the Bolt, as I understand, a different technology, the recall. When do you think you'll understand what went wrong with the Bolt so you can fix it?
Well, we already understand that when 2 very specific manufacturing defects happen in the same cell, that's when there's an issue. And, we're working with LG Chem to make sure that those issues are solved. And then we'll be able to provide battery cell and module replacements for our customers. But I think it's important, as you mentioned, the ULTIUM technology is very different than what's in the Bolt. And I believe the lessons learned that we have through this experience are really going to benefit the entire industry and the importance of the manufacturing processes. And with our joint venture with LG, who is a valued partner, we are going to be able to combine their expertise with our expertise. So I have a lot of confidence in our ULTIUM platform.
You mentioned that LG Chem is a valued partner. As far as I can tell, it's your only partner when it comes to battery technology. Some others have gone a different way and had 2 or 3 different horses in the race. Does the experience with the Bolt raise any questions in your mind about putting all your eggs into that basket, the ULTIUM basket?
Well, I would say we are working, we work with LG, but we also have our internal work. We have one of the largest battery development labs, I think, in the country, and we're building a manufacturing lab as well. But we also have a partnership with Solid Energy Solutions. So we have multiple pathways with battery technology to make sure we're going to have a leadership position. And the flexibility that's been designed into the ULTIUM platform is many different chemistries can be introduced. So that's where I think we're really well positioned as we go forward to use the best battery technologies.
As you effectuate, as I say, this fundamental transformation, it's going to change the supply chain a lot. You're going to need very different components, not just batteries, but other things as well, to make it all work. Where are we with semiconductors right now? Is that an indication of what's to come as we go over to EVs?
Well, I think the semiconductor shortage has some very specific things that caused it. It continues to be a challenge today because of COVID and the impact in Southeast Asia, specifically Malaysia. So it continues to be a very volatile situation. But that's in the short term. I think as we move out, and I can tell you that General Motors, not only with semiconductors, but also all of the critical parts, minerals, precious precious metals that we need to build EVs and continue to build ICE, we are working to have either partnerships or joint ventures to make sure we won't be inhibited by supply as we go forward.
So I find this a really important and interesting point. There's always a build it or buy it issue when it comes to the components put into a car. And you're suggesting maybe there's a middle course where you don't simply buy a part, you don't make it yourself, but you have partnerships or joint ventures so you perhaps have more influence or control over the production. Is that where you're going with your supply chain?
Well, we're looking, there'll be a variety of solutions. I think if you look at how we're approaching EVs, we decided long ago that we wanted to be responsible for the battery cell manufacturer, pack manufacturer, so we've already done that. We also have a family of motors that we're building internally as well for our electric vehicles, and then all of the software and control systems are being done internally as well. So we use the shift to EVs to really say what are the key components, the places we want to control that we can differentiate ourselves because of our technological capability, and we've already done that. As it relates to all the different components that we need, we'll look at a series of strategic arrangements, joint ventures, or traditional supply agreements.
That was Mary Barra, Chair and CEO of GM. Coming up, one more thought. How can you make golf harder than it already is? Try running the course. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Having it both ways. It's what all of us really want, right? Not to have to choose between two things when we really want them both, like getting everyone back to the office without risking more COVID infections.
We will not come back to something similar to before the pandemic. We will adapt the way to work.
We're having good conversations with employees about the benefits and then implementing the safety guidelines.
Or having the Fed taper without causing a tantrum.
It's a very difficult risk management issue, and that's exactly why there's such a debate around that table.
But now the Wall Street Journal brings us news of a 36-year-old mother of three from upstate New York who has given us all hope, or maybe just put us all to shame, as she does something any of us who have ever picked up a golf club would think was impossible: play golf extraordinarily well and play it really fast. Lauren Cupp is the head coach of the men's and women's golf teams at Hamilton College, and she took up the sport of speed golf just after she had her first child. The idea of speed golf is to play as well as you can and as fast as you can. And to give you some sense of just how well and just how fast, Ms. Cupp just set a new record by shooting 1 under par for 18 holes in 50 minutes. Yes, that's 50 minutes for 18 holes. That's what takes most of us 3 or even 4 hours, and that's on a good day. So how does she do it? Well, she carries only 5 clubs: a driver, a putter, a 6-iron, a 9-iron, and a wedge. And whenever she can, she runs right through water hazards like creeks. And oh yes, she never ever takes more than 20 seconds to look for a ball. Something that you might want to suggest to that member of your foursome who hits the ball into the woods and then insists on trying to find it. But first and foremost, there is one key rule for speed golf. Above all, hit it straight. And at least in that one way, Lauren Cupp's approach to speed golf might serve us all in good stead. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.